Why the Strait of Hormuz could trigger the next global market crisis. Imagine waking up tomorrow and seeing gas prices jump overnight. Your grocery bill climbs. Flights become more expensive. The stock market opens deep in the red. And suddenly everyone, from Wall Street billionaires to everyday investors, is talking about one tiny stretch of water most people couldn't even find on a map. The Strait of Hormuz. It sounds like the name of an ancient kingdom, but in reality, it's one of the most important economic choke points on Earth. And here's the crazy part. It's only about 21 miles, or roughly 34 kilometers wide at its narrowest point. Yet every single day, trillions of dollars in global trade depend on it staying open. Now here's the question. How can one narrow waterway have the power to shake the entire global economy? More importantly, why should investors, especially young investors, care? Because history has shown something fascinating. Stock market crashes don't always begin on Wall Street. Sometimes they begin thousands of miles away. On shipping routes, oil tankers, political conflicts, places most investors completely ignore. And that's exactly why understanding the Strait of Hormuz could give you an edge long before everyone else starts panicking. But before we dive into what happens if this critical route is disrupted, you first need to understand why this tiny passage became one of the world's biggest financial pressure points. Because once you see the numbers, everything else starts making sense. Chapter 1. The tiny waterway that powers the world picture, the world's economy as the human body. Factories are the muscles, banks are the brain, consumers are the heart. But oil is the blood. Without it, nothing moves. Every day, roughly 1/5 of the world's oil supply passes through the Strait of Hormuz. Think about that for a second. 1 out of every 5 barrels. Cars, airplanes, factories, cargo ships, power plants, they're all indirectly connected to this tiny passage between Iran and Oman. It's almost unbelievable. Imagine if one bridge carried 20% of every truck delivering food across America. Wouldn't you keep an eye on that bridge? Exactly. Now here's something even more interesting. Markets don't wait for disasters to happen. They react to the possibility of disaster. That's why a single headline mentioning rising tensions near the strait can send oil prices soaring within hours. It's like investors are playing chess, not checkers. They're constantly trying to predict the next move. And speaking of predictions, let's explore what happens if that worst-case scenario actually unfolds. Because this is where things become much more serious. Chapter 2. What happens if the strait closes? Imagine you're running the world's biggest highway. Then, someone suddenly closes every lane. Chaos. That's exactly what a shutdown of the Strait of Hormuz would look like. Oil tankers can't move. Exports slow down. Supply instantly becomes tighter. Now here's an investing lesson many people miss. Prices aren't determined only by supply. They're determined by expected future supply. Even if oil keeps flowing today, if markets believe tomorrow's shipments are at risk, prices start climbing immediately. It's fear, not facts. And markets price fear incredibly fast. Have you ever noticed how people rush to buy bottled water before a hurricane, even if it hasn't started raining yet? Financial markets behave the same way, except instead of bottled water, they're buying or selling billions of dollars worth of assets. Oil spikes, investors panic, news channels go into overdrive, and suddenly, the problem is no longer just about oil. It's about the entire economy, which brings us to the domino effect almost nobody talks about. Chapter 3. The domino effect. Investors can't ignore. Higher oil prices don't stay at gas stations. They travel, almost like a virus moving through the economy. Shipping companies pay more, airlines pay more, factories pay more, farmers pay more, retailers pay more. Eventually, consumers pay more. Inflation begins rising. Now here's where things get dangerous. When inflation rises, central banks often respond by keeping interest rates higher. Borrowing becomes more expensive. Businesses slow investment. Consumers reduce spending. Corporate earnings weaken. And that's when stock markets begin feeling real pressure. Notice something? The Strait of Hormuz isn't directly crashing the stock market. It's triggering a chain reaction, a financial domino effect. One piece falls, then another, until suddenly, everyone wonders why their investment portfolio is shrinking. But here's the surprising twist. Not every company loses during moments like these. Some actually benefit. Chapter 4. Winners and losers. Every crisis creates opportunity. That's one lesson history keeps repeating. While airlines struggle with higher fuel costs, energy companies often see stronger revenues. Oil producers may benefit from rising crude prices. Some defense companies gain attention as geopolitical tensions increase. Even certain shipping firms can see changing demand depending on market conditions. Meanwhile, companies relying heavily on transportation and fuel often face rising costs. Think airlines, cruise operators, logistics companies, consumer brands with thin profit margins. Here's a funny thought. Imagine trying to run an airline when jet fuel suddenly costs dramatically more. That's like opening an ice cream shop in Antarctica. Technically possible, but not exactly ideal. This is why successful investors don't simply ask, what will happen? They ask, who benefits if it happens? Because fortunes are often built by understanding second-order effects before everyone else notices them. But even this isn't the biggest lesson. The biggest lesson comes from history itself. Chapter 5. History doesn't repeat, but it rhymes. Every major market crisis feels unique until you zoom out. The 1970s oil crisis, the Gulf War, periods of rising tensions across the Middle East, different events, same pattern, energy uncertainty, higher oil prices, economic stress, market volatility. The details change. Human psychology doesn't. Fear spreads. Investors overreact. Media headlines become louder, and opportunities quietly emerge for those who remain calm. Here's something worth remembering. The biggest investment mistakes rarely happen because people lack intelligence. They happen because emotions take control. When fear dominates, people sell great investments at terrible prices. When excitement returns, they buy after prices have already surged. That's why understanding global events isn't about predicting the future perfectly. It's about preparing before everyone else starts reacting. And that brings us to the most important takeaway of this entire video. The Strait of Hormuz is more than just a narrow stretch of water. It's a reminder that in today's interconnected world, a local conflict can become a global financial event almost overnight. Smart investing isn't just about reading earnings reports. It's about understanding how geopolitics, energy, inflation, interest rates, and investor psychology all connect, because markets are like giant webs. Pull one thread, and vibrations travel everywhere. The investors who succeed over the long term aren't the ones who react the fastest. They're the ones who understand the chain reaction before it begins.
So the next time you hear news about the Strait of Hormuz, just remember how vital this narrow waterway is to the entire world.
Don't just think about oil. Think about inflation, corporate profits, interest rates, and ultimately, your portfolio, because that's how long-term investors think.
If you found this video valuable and want to understand the bigger picture of why markets experience massive sell-offs, click the video appearing on your screen right now. What causes stock market crashes? It breaks down the hidden forces behind market crashes, and once you watch it, you'll start seeing the financial world through a completely different lens. I'll see you there.